Talking about this. I'm talking about this.
Dumb money, man.
Happy to take it.
GameStop.
The world of investing can be a jungle. The bulls charge, the bears retreat, and the smart ones, well, they've got diamond hands. Fortunes are made and lost with a single click. This isn't just about stocks, it's a battlefield. This story is about the money game played between two classes of people who went head to head. Dumb money and smart money. Smart money represents the Wall Street hedge funds, institutional investors with billions of dollars, making up the 1% of the top 1%. On the other side, there is dumb money. Individual investors or retail traders perceived as inexperienced, uninformed, or lacking sophistication in their investment decisions. But when enough of dumb money comes together, it transforms into smart money. This transformation of dumb money flipped the script on Wall Street and got rich by turning GameStop, a video game store, into the world's hottest company. In this video, I'll be breaking down the insane true story of Dumb Money, a finance movie inspired by the book Anti-Social Network. It's all about the roller coaster ride of GameStop stock in January 2021 and how big Wall Street hedge funds lost billions to regular people. It's an epic tale of powerful giants fighting back against a surge of dumb money, using groundbreaking tactics and altering the market according to their own interests. It all started with this guy, Keith Gill. Known as Roaring Kitty on YouTube and Deep Fucking Value on Reddit, he was a financial analyst and a rational YouTuber. With a knack for the stock market, he stumbled upon GameStop. The once thriving video game retailer was on the brink of collapse, a prime target for hedge funds seeking to profit from its downfall. Recognizing the potential for a turnaround, Keith decided to invest his life savings and purchased around $53,000 in call options on GameStop's stock in 2019. A call option is similar to placing a bet on a stock. It allows you to purchase the stock at a predetermined price, resembling a special agreement or deal. If the stock's price goes up, you can buy it at a lower, agreed-upon price, possibly making a profit. But if the stock doesn't go up, and you choose not to buy the stock using the option, you might lose the money you paid for the option, known as the premium. This is the risk of buying options. You could lose the premium if the anticipated market move doesn't happen. Keith Gill shared information about his investment on the subreddit Wall Street Bets, an online community on Reddit known for discussions about meme stocks and high-risk stock transactions. Providing regular updates on the investment's performance, including times when the investment had dropped significantly, he became a central figure in what would become a rebellion against the Wall Street establishment. As more retail investors joined the cause, the movement gained momentum. Regular people, often dismissed by traditional financial institutions, find strength in numbers. People watching Wall Street Bets believed the company was significantly undervalued, and with such a large amount of the stock being short, they could trigger a short squeeze by driving up the price to the point where hedge funds, who were the short sellers, had to give in and buy back their stocks at big losses. I know you might be thinking, what the hell are these short sellers and what's a short squeeze? Let's break it down in simpler terms. Imagine you have a friend who lends you their bike, and you decide to sell it, expecting the price to drop. That's what short sellers do. They borrow stocks, sell them, hoping the prices fall, and plan to buy them back later at a lower price. Now picture this. Instead of the price going down, it starts going up. Uh-oh, that's a problem for short sellers because they have to buy back those stocks at a higher price. The more it goes up, the more they lose. This tricky situation is what we call a short squeeze. In the GameStop saga, a group of small investors noticed big hedge funds were betting big money that GameStop's stock would go down. So they decided to buy a ton of GameStop shares, causing the price to skyrocket. This forced the big hedge funds to panic buy back the shares at higher prices, trying to limit their losses. This whole situation is called a short squeeze. A move by small investors that squeezed the big guys out of their short positions. The unexpected surge in GameStop's price caught the hedge funds off guard, and they had to scramble to cover their bets. Here's the kicker. The higher the price goes, the higher the big hedge funds have to buy, and the higher they buy, the higher the stock prices go. It becomes a cycle where all the individual investors holding GameStop stock end up making a profit. On the other side, we have the hedge funds, mainly Melvin Capital, founded and run by Gabe Plotkin, an investment fund that has heavily shorted GameStop since 2014. Starting 2021 with more than $12 billion, it faced a staggering loss of 53% in January, amounting to approximately $6.8 billion, forcing it to scramble to cover its short positions. However, these Wall Street giants know how to play the game with the power of money. So, Melvin Capital was backed by two other hedge funds, Ken Griffin's Citadel LLC and Point72 Asset Management, led by Mr. Cohen, the two giants of Wall Street. Seeing an opportunity to stabilize Melvin Capital and perhaps turn the tide, Citadel LLC and its partners injected a substantial $2 billion into Melvin. Simultaneously, Point72 Asset Management added $750 million to the rescue mission, bringing the total investment to a jaw-dropping $2.75 billion as a bailout. On January 25th, over 175 million shares of GameStop were traded, representing the second largest total in a single day. A significant portion of the buying came from institutional investors, including hedge funds, as many professional investors engage in high-momentum stocks, making substantial profits. Additionally, young teenage investors on the internet, particularly those following Roaring Kitty on Reddit and social media, actively joined the stock frenzy. This surge was facilitated by Robinhood Markets, co-founded by Baiju Bhatt and Vlad Tenev, a commission-free stock trading and investing app. Robinhood enables commission-free trades of stocks, exchange-traded funds, and cryptocurrencies via a mobile app, making it even more accessible for people to buy into the GameStop craze. The peak of GameStop's stock price occurred on January 27, 2021, reaching a momentary value of $483 per share, marking the intraday high for GameStop. This surge was triggered, in part, by Elon Musk, who, on January 26, tweeted a link to the Wall Street Bets Reddit with the caption, "GameStonk." This tweet led to a substantial increase in GameStop's price to over $200 per share. The heightened attention resulted in the stock closing at $347.51 per share on January 27th, reflecting a remarkable increase of over 1,700% from the beginning of the month. However, the success story took a sudden turn when the giants decided to fight back, putting an end to the music. On January 28th, the subreddit r/WallStreetBets on Reddit and its Discord server was banned due to violations of the platform's restrictions on hateful and discriminatory content. Robinhood, the popular trading platform at that time, sparked controversy by putting a stop to purchases of GameStop and other volatile stocks such as AMC Theaters, BlackBerry Limited, and Nokia Corporation, which experienced surges. This decision prevented customers from buying more of these stocks, but they could still sell the ones they already had. The move by Robinhood prompted other brokerages to quickly follow suit, leading to a surge of anger among traders who called for class action lawsuits in various Reddit posts. On January 29th, Robinhood explained in a blog post that they had to keep a lot of money to handle all the trades. This is because their clearinghouse, which manages the exchange of shares and money during trades, requires a substantial amount of money on hand. The decision was influenced by high market volatility, making it difficult for them to afford as a smaller broker. Robinhood's CEO, Vlad Tenev, gave more details on January 31st during a conversation with Tesla's CEO, Elon Musk, on the Clubhouse app. He mentioned that at 3:30 a.m. Pacific Time, they got a request from the National Securities Clearing Corporation, NSCC, for a deposit of around $3 billion. This was way more than usual, and Tenev explained that it was based on a formula the NSCC uses, which considers risk as a factor. Tenev emphasized that they had no choice but to follow regulatory rules, and since then, they worked with the agency to reduce the required funds. After the markets closed, Robinhood announced that it would allow limited buys of the affected securities starting the next day. However, the specifics of what constituted limited buys remained unclear. Concurrently, other trading platforms, including UK-based Trading 212 and Israel-based eToro, also restricted purchases of GameStop and other stocks while allowing sales. In addition, on January 28, 2021, the House Financial Services Committee announced a remote hearing titled "GameStop: Who Wins and Loses When Short Sellers, Social Media, and Retail Investors Collide on February 18th. On February 1st and 2, GameStop's stock price took a big hit, dropping more than 80% from its highest point just a week earlier. On February 2nd alone, GameStop shares lost 60% of their value, closing below $100 for the first time in a week. As the stock prices continued to decline, some of the recent investors held onto their shares and suffered significant losses. Keith Gill lost $30 million in just 2 days after the price dropped dramatically, and he shared this information on Wall Street Bets after it was back up. The GameStop story took an unexpected turn when Robinhood stopped people from buying certain stocks, leading to question its connection with Citadel Securities. It was revealed that a significant portion of Robinhood's revenue, approximately 40%, came from selling customer orders to companies like Citadel Securities, which, in turn, pays Robinhood a small fee for each trade. This practice is known as payment for order flow. Now, here's where it gets interesting. At the time of the GameStop rally, Robinhood was making about a third of its money from one of these market makers, Citadel Securities. Citadel Securities, which was in turn linked to Citadel LLC, was owned by Kenneth Griffin. Griffin, who at the same time had invested a lot in Melvin Capital, got accused of influencing Robinhood to limit trading for GameStop. However, Citadel Securities denied this, stating they didn't tell any brokerage to stop or limit trading. Robinhood also said they weren't pushed by Citadel. All these connections between Melvin Capital, Citadel LLC, Citadel Securities, and Robinhood really set us up for the big controversy. On February 18th, chaired by Representative Maxine Waters, they held a remote hearing titled GameStop: Who Wins and Loses When Short Sellers, Social Media, and Retail Investors Collide. Witnesses included Keith Gill, Ken Griffin, Steve Huffman, Gabe Plotkin, Jennifer J. Schulp, and Vlad Tenev. During the hearing, Citadel CEO Kenneth Griffin and Robinhood CEO Vlad Tenev were asked about their relationship. Both said Citadel didn't influence the limits on GameStop trading, but people on social media started questioning if this was true, creating internet conspiracies and Twitter trends. Citadel responded to these doubts, calling them internet conspiracies and Twitter mobs. They denied making Robinhood limit trading in GameStop. The hashtag #KenGriffinLied trended on Twitter, with users accusing Citadel's CEO Ken Griffin of lying under oath to Congress. Internal messages revealed during a lawsuit added more drama. They showed Robinhood executives talking to Citadel CEO Ken Griffin on January 27, 2021, the day trading of GameStop was stopped. The lawsuit suggested that Citadel pressured Robinhood. Messages from Robinhood's COO Jim Swartwout described the conversation with Citadel as a total mess. During a congressional hearing, lawmakers asked Ken Griffin if anyone at Citadel pressured Robinhood. Griffin strongly denied it, saying, "Absolutely not." The alleged conflict of interest between Robinhood and Citadel became a significant part of the GameStop story, raising concerns about the influence of these big companies on trading platforms for regular people. Keith Gill, in his testimony, he talked about why he bought GameStop stock and shared the information on social media. He wanted everyone to know that he wasn't a big investor or a financial expert. He was just a regular guy who did his own research before investing. Keith shared his story of growing up in Massachusetts and struggling to find a job before finally landing one in marketing and finance. He explained why he thought GameStop was a good investment, especially because he believed it could change and do well in the gaming industry. Keith said that when he talked about GameStop on social media, it was just like chatting with friends about stocks. He understood that investing in stocks could be risky and felt sorry for anyone who lost money. Keith also mentioned that he finds it alarming how little we know about how the stock market works, and he's grateful that the committee is looking into it. He expressed his support for retail investors' rights to invest however they want, and said he's still optimistic about GameStop's future. Finally, he concluded his testimony with the now famous phrase, "I like the stock," a statement that had another major ripple effect on the price as it tripled a week after the congressional hearing. One of the biggest questions for the movie is whether Keith Gill sold his GameStop shares. The final scene of Dumb Money shows Keith's net worth was $34 million. The lawsuit against Citadel Securities and Robinhood was dismissed. U.S. Appellate Court Judge Britt Grant ruled that the investors failed to present evidence of collusion during the meme stock frenzy. Judge Grant explained that Robinhood had the right to do exactly what they did because they were not legally obligated to protect investors from pure economic loss. So, what do you think about this decision? Does it matter if you stand up to the power of smart money? It shows how the system can sometimes seem unfair, with large companies having a lot of influence, while regular people often feel like we're left out in the cold. But one thing is clear: Wall Street will never be able to ignore the so-called dumb money again. Wall Street is the place where money never sleeps, and being called the Wolf of Wall Street is a testament to one's power in manipulating the markets, where cunning, ruthlessness, and ambition reign supreme. Watch this video to know how Jordan Belfort's notorious scams worked in real life. Don't forget to like this video and subscribe to The Money Game to level up your financial game today.